In the electrifying world of finance, where dreams are built and fortunes are shattered in the blink of an eye, picture Wall Street, the ultimate arena of power and prestige. You'd expect the king of Wall Street to be a silver-spoon mogul, right? After all, most Wall Street legends are well-credentialed, expertly connected, and come from backgrounds that practically spell success. But what if I told you there is an extraordinary story out there, a real-life rags-to-riches saga that defies all expectations? Today, we're diving into the awe-inspiring journey of one man who broke all the rules. From a challenging, modest upbringing, fighting every inch just to stay relevant, he rose to become a titan in the financial capital of the world. With grit that could move mountains, relentless hustle, unwavering determination, and razor-sharp intellect, he defied every odds to rise to the pinnacle of finance. Enter the extraordinary journey of Larry Fink, the genius CEO of BlackRock, a man who's rightly earned the nickname $10 trillion man. Larry's story is nothing short of a modern-day legend, taking him from an ordinary school student to the helm of the world's largest finance company, which virtually owns everything. So the question is, how did Larry Fink pull off such a meteoric rise? How did an ordinary student transform into a mastermind behind the world's largest finance company? What made him stand out amidst a sea of already successful business minds? Brace yourselves as we unravel the captivating saga of his unstoppable ascent, his money-making brilliance, and his unparalleled dominance in the finance world. Join us as we peel back the layers on Larry Fink's incredible rise to power. Larry Fink's story is not just one of financial acumen, but a saga of grit and perseverance. Born in the urban neighborhood of Van Nuys, located in the San Fernando Valley in the state of California on November 2, 1952, Fink's early years were far from the luxury associated with the corridors of power in New York's financial district. He grew up in a modest Jewish family, with his mother working as an English professor at California State University and his father owning a shoe store. As a teenager, young Larry knew that he was not born with a silver spoon. He aimed to help his father in the shoe store, manning the shop to achieve more in life and become established. Larry's formative years were deeply influenced by his parents' hard work and dedication. His mother's commitment to education and his father's entrepreneurial spirit left a lasting impression on him. The young Larry took on responsibilities at an early age, assisting his father in the shoe store and learning the values of diligence and customer service. This hands-on experience in the family business instilled in him a strong work ethic and a desire to succeed. Academically, Larry was driven by a need to distinguish himself, particularly in contrast to his siblings. His older brother's academic superiority was a constant challenge, pushing Larry to strive harder. This sibling rivalry fueled his ambition and determination to excel in his studies. He recognized that education was his pathway to achieving greater things in life, far beyond the confines of the family shoe store. This humble beginning, especially of working for his father, the lack of a generational wealth which proved to be a source for growth and abundance for some of his contemporaries, and his competition from his older brother did not deter Fink. It only fueled his ambition to strive for greatness in the world of finance and wealth. He pursued a degree in political science at University of California, Los Angeles, or UCLA, in 1974. Majoring in political theory, delving into the classical and modern forms of philosophies that will explain the political world, and later an MBA at the UCLA Anderson School of Management, which he attained in 1976. It was during his time in UCLA, in pursuit of his master's in business administration, in which he became even more hooked towards the notion of business. The concepts he learned from his time at the School of Management, such as its concentration on real estate, were all important towards his quest towards his financial greatness. And in turn, it helped him to prepare in the real world of finance and towards his journey to the money capital of the United States, Wall Street. By the time Larry entered Wall Street in 1976, the legendary financial district was a bustling hive of ambition and opportunity. Larry roamed its storied corridors, searching for his first job in finance. Offers from prestigious investment and banking firms like Goldman Sachs came his way, but he later admitted that turning down Goldman Sachs was one of his biggest regrets, given the firm's unparalleled legacy in the financial world. Despite missing this chance, Larry's initial stride towards financial success came when he joined the First Boston Corporation, another heavyweight in the investment banking sector renowned for its formidable reputation on Wall Street. At First Boston, Larry's expertise in real estate led him to trade mortgage-backed bonds, a niche but burgeoning market at the time. By 1978, his sharp acumen and innovative strategies had earned him a sterling reputation within the company. Larry swiftly climbed the corporate ladder, taking on significant positions such as managing director and co-head of the Taxable Fixed Income Division, or TFID. His innovative spirit didn't stop there. He pioneered the Financial Futures and Options Department, a move that showcased his foresight into emerging financial instruments. Additionally, leading the mortgage and real estate products group, he capitalized on his extensive knowledge of the real estate sector. These positions were not just titles, they were pivotal roles that laid the groundwork for Larry's future endeavors in the financial world. Larry's journey through First Boston was marked by a series of strategic maneuvers and bold decisions, each contributing to his growing influence and setting the stage for his future successes. His time at First Boston was a crucible of learning and leadership, shaping him into a formidable player on Wall Street. Such strategic maneuvers were also motivated by discriminatory practices against him and his fellow employees by members of the First Boston Corporation. The 1970s was a time that saw the end of racial segregation for most of the United States, yet practices of discrimination and racism still persist within the financial world. Being from a Jewish background and working with other people of foreign descent such as Italians, they faced forms of discrimination, such as being called various slurs, and wherein the group of Fink even called as Little Israel. One such fellow member of Fink's group was Robert Stephen Capito, which will be an integral individual for Fink's future endeavors in Wall Street. With his keen financial acumen, particularly in bonds and real estate, he quickly garnered support from his colleagues at the First Boston Corporation. Yet, despite this support, Fink also encountered opposition from other members within First Boston and even beyond the company. Reflecting on his early career, Fink admitted that his attitude often came off as somewhat of a jerk. This self-awareness did little to slow his ascent. Undeterred, Fink's relentless drive and exceptional skills propelled him forward. By the dawn of the 1980s, his hard work and strategic prowess earned him the distinction of becoming the youngest managing director at First Boston at the age of 31. This achievement was not just a testament to his financial expertise, but also to his ability to navigate the complex and competitive world of investment banking. Fink's journey at First Boston was marked by a blend of support and resistance, reflecting the high-stakes environment of Wall Street. Despite the challenges, his ability to innovate and lead secured his rapid rise within the company. His tenure at First Boston laid a solid foundation for his future successes, showcasing his resilience and determination in the face of adversity. By the 1980s, challenges soon came into fruition for his career in the financial world. In 1986, after the financial crisis that affected banking and financial institutions not just on Wall Street but throughout the United States, First Boston experienced a massive loss largely blamed on Fink's committee. Accounts showcased Fink's exceptional impact during his tenure at First Boston, where he elevated the company's earnings by approximately $1 billion in US dollars. However, by 1986, due to discrepancies within the risk management team and their failure to assess market volatility, the company suffered a $100 million loss because of his miscalculated forecast on interest rates for their investments. Despite his impressive trajectory from a staffer to a committee member to the managing director of his department and a potential future CEO, Fink faced a harsh reality. The significant losses suffered by both his department and the company itself marked a turning point. The once proud and up-and-coming Fink was humiliated and ultimately ousted in the same year. This setback was a stark contrast to his earlier successes, highlighting the precarious nature of the financial industry. The fall from grace was swift and public, underscoring the high stakes and relentless pressure that came with a career on Wall Street. As the decade progressed, the experienced Fink still persisted on in his line of work and found various opportunities that could help kickstart his career again after the humiliating end to an illustrious career in First Boston in 1986. By 1987, he became well acquainted with Ralph Schlosstein, a wealthy investment banker at the prestigious Shearson Lehman Hutton, and would even become phone pals due to their forms of similarities in their routine as well as in their industry. Being phone pals, they talked a lot about the market before it opened at around 6 a.m. And this, along with somewhat of a chance meeting for a dinner during March, and in that night, a crucial business idea was exchanged between the two moguls. The two, exchanging their political views and ties to the Democratic Party, found common ground in their dissatisfaction with the current financial system, especially on Wall Street. This shared frustration led them to conceive a revolutionary idea: creating a company focused on modeling financial securities, consolidating them into portfolios, and conducting in-depth risk analysis to improve investment strategies. Leveraging their extensive connections within their respective companies and firms, particularly those Fink had fostered at First Boston, they began sketching out plans. Fink's network included key figures like Capito, a trusted confidant in the department, and Barbara Novick, Ben Golub, and Keith Anderson. Each of these individuals played a crucial role in the early success of the First Boston Corporation and Fink's department, specializing in areas such as portfolio products, bond and risk analysis, and more. Their expertise and collaboration were instrumental in shaping the innovative vision for the new company. Schlossstein brought invaluable talent to the table by recruiting Susan Wagner and later Hugh Frater, two of the most brilliant mortgage bond specialists in the industry. Together, they envisioned a firm grounded in cutting-edge technology and a new approach to investment. Their combined expertise and shared determination set the stage for a venture that would challenge the status quo and potentially transform the landscape of financial services. This collective effort, born out of dissatisfaction and a desire for innovation, laid the foundation for what would become a groundbreaking new enterprise in the world of finance. Eventually, Fink and Schlossstein sought help from major players in Wall Street. They needed the necessary capital to start up their company. The pair collaborated with the prominent Wall Street investment from Blackstone, founded by ex-Lehman bankers Steve Schwartzman and Pete Peterson. Through a $5 million loan from the Blackstone company, and as well as providing a 50% stake for the company, Fink and Schlossstein, from merely being phone pals of the same interest and having a business idea from their dissatisfaction from the status quo of the finance market, the two formed the Blackstone Financial Management, or BFM. Throughout the first 6 years of the company, BFM enjoyed relatively great success. Through hires such as Charlie Hollack, who became a key recruiter for clients for their investment fund, and as well as the development of new features that were never before seen in Wall Street, such as an electronic system built for risk management which is needed to avoid further issues such as what Fink has experienced in 1986, called Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network. This network, which saw its humble beginnings in the first office of BFM, became an integral facet of the first 6 years' success, with about $23 billion in revenue and about 150 employees joined from its inception and to 1993. As the company moved towards a dramatic separation from Blackstone, tensions were rising. Fink had attracted numerous fresh recruits by tempting them with shares of equity, a move that slowly eroded Blackstone's stake. This calculated tactic irked Blackstone's Stephen Schwartzman. Tired of the escalating tension, Fink determined that BFM and Blackstone had to go their separate paths. Each of BFM's funds bore unique tickers, serving as identification codes in regulatory documents and data, all starting with the letter B. Despite this, a pact with Blackstone mandated that the rebranded name must exclude any mention of Black or Stone. The team pondered the name Bedrock, yet found it evoked too many associations with the Flintstones. After much deliberation, the founders settled on BlackRock, a name they loved. Presenting their case to Schwartzman and Peter Peterson, they highlighted how the 1930s separation between Morgan Stanley and JP Morgan had ultimately been advantageous for both companies. The concept of BlackRock as a nod to Blackstone brought a chuckle to Peterson and Schwartzman, leading to their approval of the new name. This decision marked a pivotal moment in the company's history. The name BlackRock symbolized a fresh start while acknowledging its origins. This rebranding effort was more than just a change of name. It signaled a new chapter in the company's evolution, emphasizing independence and a forward-thinking approach. With the blessing of Schwartzman and Peterson, BlackRock embarked on its journey, poised to make a significant impact on the financial world. The stage was set for BlackRock to carve out its own identity, separate from Blackstone, while still honoring the legacy of its beginnings. In 1994, during a period of continuous innovation such as the rise of the internet, a pivotal event unfolded as Blackstone offloaded its BlackRock stake to PNC Bank in Pittsburgh for $240 million. This deal marked a significant milestone for both entities. PNC Bank consolidated all its money management operations into BlackRock, paving the way for a new phase of growth and expansion. As BlackRock absorbed PNC's operations, it positioned itself as a formidable player in the financial world. the company's assets under management soared, reflecting its increasing influence and capacity. By the time BlackRock prepared for its long-anticipated initial public offering, or IPO, the groundwork had been meticulously laid for a major market debut. On October 1st, 1999, BlackRock went public, marking a significant milestone in its journey. At the time of the IPO, BlackRock boasted a remarkable $165 billion in assets under its management, highlighting its substantial growth. This figure not only underscored the company's rapid growth, but also its successful integration of PNC's operations and the effective strategies implemented by its leadership. However, challenges continued to befall Fink and his company, wherein the value of the company and the IPO itself was lower than expected due to factors such as that the arrangement of the company, Merrill Lynch, under the Bank of America, to be at about only under $900 million. However, after the burst of the dot-com bubble in the late 90s and early 2000s, BlackRock rebounded. Through a bond-oriented business in which Fink and his contemporaries innovated a decade prior, it innovated from merely being a narrow bond investing company to a global presence for money management. This was exemplified throughout the acquisition and deals made by Fink and his company, such as in 2004, the company acquired State Street Research, a fund manager previously owned by insurer MetLife, in a $375 million deal, one of its highest acquisitions at the time. Throughout the 2000s, specifically in the year 2006, Fink and his company sought to acquire Merrill Lynch's management arm, the Merrill Lynch Investment Managers, and that this has seen to be a divided form of acquisition, especially for the leaders of Merrill Lynch. Granted that with the acquisition, nearly $1 trillion worth of assets will be divided by the two groups, as well as the differences towards the personalities, especially of Fink, the diplomatic Schlosstein, and Capito. Among other leaders of BlackRock, they continued on with the acquisition, even experiencing issues by 2007, wherein Fink was tested, given the financial crisis that will occur by 2008, and more so, other forms of acquisitions. BlackRock's significant involvement with the U.S. Treasury and the Federal Reserve during the financial crisis garnered criticism due to concerns over its perceived proximity to governmental power. Critics argued that BlackRock's advisory roles gave it undue influence, raising questions about conflicts of interest and the integrity of its operations. Compounding these concerns was the increasing dominance of Aladdin, BlackRock's sophisticated risk management system. Aladdin's widespread adoption among investors alarmed regulators. They feared that the reliance on a single risk analysis platform could lead to a dangerous homogeneity in investment strategies, potentially amplifying systemic risks during financial turbulence. The pivotal moment for BlackRock's ascendancy came in 2009 with its acquisition of Barclays Global Investors, or BGI. This tactical decision significantly expanded BlackRock's asset management capabilities and market reach. The merger with BGI propelled BlackRock into the upper echelons of Wall Street, solidifying its status as the world's largest asset manager. The rapid growth and increased influence following this acquisition cemented Larry Fink's position as a leading figure in the financial industry. Since 2009, Larry Fink, the CEO of BlackRock, has guided the firm through significant growth and strategic developments, solidifying its status as a global financial giant. A pivotal moment in this journey was the 2009 acquisition of Barclays Global Investors, or BGI, for $13.5 billion. This deal not only enhanced BlackRock's asset management capabilities, but also integrated iShares, a leading exchange-traded fund, or ETF, provider, into its portfolio. This acquisition propelled BlackRock to the forefront of the asset management industry, establishing it as the largest asset manager worldwide. Under Fink's leadership, BlackRock has continually innovated and expanded its influence. The firm's proprietary risk management platform, Aladdin, became essential for investors globally, offering extensive tools for portfolio management and risk analysis. Despite regulatory concerns about the potential systemic risks associated with widespread reliance on a single platform, Aladdin's adoption grew, reinforcing BlackRock's critical role in global finance. BlackRock also made significant advances in promoting sustainable investing. In 2020, Fink's annual letter to CEOs highlighted the importance of sustainability and climate risk, signaling a major shift towards environmental, social, and governance, or ESG, criteria and investment strategies. This calculated action positioned BlackRock as a leader in responsible investing, in line with broader trends towards sustainability in the financial sector. In recent years, BlackRock has expanded its global presence through strategic acquisitions and partnerships, while also managing regulatory scrutiny and market challenges. By 2024, the firm's assets under management had soared to almost $10.5 trillion, reflecting its unparalleled scale and influence. Larry Fink's visionary leadership has thus transformed BlackRock into a dominant force in the financial world, shaping the future of investment management and corporate governance. In conclusion, BlackRock's journey, punctuated with both triumphs and setbacks, epitomizes the dynamic nature of the financial world. Even after marking down the value of its stake in Baiju's to zero in January 2024, a major blow to what was once a $22 billion investment, BlackRock demonstrated its resilience by achieving a significant milestone with its Bitcoin ETF, which crossed an impressive $20 billion in assets under management. This rebound showcases the firm's ability to navigate through adversity and emerge stronger, much like a phoenix rising from the ashes. Larry Fink, BlackRock's formidable leader, exemplifies personal and professional growth. By April 2024, boasting a speculated net worth of $1.2 billion, Fink's impact resonates well beyond his financial achievements. His involvement with respected institutions like the Council on Foreign Relations and the World Economic Forum underscores his vast impact on international economic policies and highlights his dedication to fostering global economic stability and growth. Fink's ascent from an innovative, yet initially sidelined trader at First Boston to helming the world's largest asset management firm underscores essential qualities of resilience, strategic foresight, and adaptability. His journey is a testament to overcoming obstacles and embracing opportunities, cementing his stature as an influential and visionary leader in the financial industry. As we look ahead to BlackRock's future, managing an astounding $10.5 trillion in assets as of 2024, the firm faces both monumental opportunities and intricate challenges. Its unprecedented scale offers vast potential, yet also necessitates adept navigation through complex global regulations and strategic succession planning. The question of Larry Fink's successor remains pivotal, marking a crucial phase in BlackRock's evolution. Ensuring a seamless leadership transition will be vital to maintaining the firm's momentum and upholding its foundational principles. Fink's enduring legacy of integrating advanced risk management, embracing innovative technology, and committing to environmental, social, and governance principles will undoubtedly guide BlackRock's future. The firm's capacity for innovation and adaptability will be instrumental in steering its success in an ever-changing financial landscape. Through the compelling saga of Larry Fink and BlackRock, we learn invaluable lessons about resilience, innovation, and principled leadership. Their story inspires and challenges us to stay curious, keep learning, and continuously adapt to what the future holds. Thank you for joining us on this journey. If you found this narrative as captivating as we did, please like, subscribe, and stay tuned for more insightful content. Until next time, keep exploring and stay informed. If you enjoyed this video, we kindly invite you to subscribe and enable notifications to stay updated on future content like this. Thank you for your support.